Hello, you're watching Deal Flow, the CNBC Africa show that keeps you informed and thinking about mergers and acquisitions in Africa and beyond. I'm Erica van der Merwe. Global financial groups have their sights set on the African banking sector, where the benefits of surging consumer strength and catch-up growth offer significant promise. South Africa's fourth largest bank, Nedbank, has now bought a R5.5 billion stake in EcoBank following a long partnership. We look in this week's show at its strategy and the strategy of other major banks. Our guests are Wayne McCurrie from Momentum Wealth and Nesan Nair from Barclays Africa. Welcome, really good to have you here.
Thank you.
Nesan, were you surprised by the deal? I mean, it's been long in the coming. So EcoBank and Nedbank have had a relationship since 2008. It was probably formalized further in 2011 with the loan that Nedbank gave EcoBank, and we knew that they had this option. Were you surprised that Nedbank took up the option? And secondly, by the size of the stake, 20% that they took?
I think it was always on the cards that Nedbank was going to expand into Africa, like Standard Bank and Barclays have done. It's the next frontier of growth for South African banks. So it didn't surprise me or the market that they ended up taking up a stake in EcoBank, which has got a very wide geographical footprint, especially in West Africa.
Yes.
The size of the deal as well, I think, also made sense because Nedbank does get board representation as well, and strategically, if they want to grow their African footprint, then they need to have a significant presence on the board of that bank.
The other element of that, Wayne, is that there are other significant shareholders too. So yes, the Qatar National Bank, the PIC from South Africa, and in order for each individual party to get ahead, they need to be in agreement about strategy, and that may not be the case.
Look, as long as things are successful, everyone's happy. So you'll only really see any shareholder dissent if things turn a little bit south. Now, EcoBank doesn't have the best history. There were lots of governance issues there. The previous CEO was kicked out, but they seem to have sorted it out. And it's quite clear they're changing their strategy a little bit. They've gone on this massive acquisition, massive expansion.
You're talking about EcoBank now?
EcoBank, yeah. They've expanded enormously. Now they say we are cutting back. We're actually going to consolidate what we got. We're going to drive efficiencies, drive profitability. So as long as that's successful, I don't think you'll see any problem on the board.
I think you're sort of skirting over these things because there always are little elements, power plays, fights for territory that could come into play here, Wayne.
Look, it could be. I mean, the PIC is not a bank, so to them it's just an investment. So they're not worried about, advancing their particular bank. Maybe with Qatar there might be some conflict. They might want their products put on the shelf, and Nedbank might want their products put on the shelf. So there could be something, but we'll see what happens. Shareholder base is obviously wide. So, I mean, by the articles of association, you cannot own more than 20%.
Right.
But, I mean, Nedbank will have an influence, obviously, now as the largest shareholder.
Yes. And so on that point then, Nesan, it seems as though in the African continent that EcoBank seems to be the prize or one of the top 3 prizes. So it's been a good move for Nedbank.
Absolutely. I think, even if you think of the price that Nedbank paid, it's on a P of about 7, forward about 5. And, these assets are not, available all the time. I think FirstRand had still has much difficulty in trying to buy a bank in that area. And to land a deal like this on a 5p, I think is an excellent deal for Nedbank.
Well, on that note, let's take a look at the banking landscape in Africa.
Over the last decade, Africa has been a vibrant region for mergers and acquisition activity, and African consumers are the key driving force for this increasingly attractive market. Since 2006, over 1,600 M&A deals have taken place.
When you acquire or when you merge with another company in a different geography, that's part of integrating your business with other businesses that might be part of a faster growing economy. As we know, Morgan Stanley downgrading the growth prospects for South Africa recently to just over 2%. That means with countries like Ethiopia, the Nigerias, the Angolas that are growing by 7% up, you need a presence in those countries because obviously the deal flow is happening there. The infrastructure financing is happening there.
Merger and acquisition activity in the banking arena has been edging forward. This seen in various deals over the last while. The Industrial and Commercial Bank of China now owns 20% of the Standard Bank Group, and Nedbank has been bolstering its alliance with EcoBank.
Banking is not what it used to be now. There are countries that didn't have much in terms of banking. They didn't have lots of branches, if we're talking brick and mortar banks, but have now managed to find very innovative solutions. So the future of banking lies in whoever will be able to master the business of data or data. I think that is one of the future influencers in the banking sector.
So, Nesan, in the context then of the strategy of the various banks in Africa, so if we look at EcoBank's strategy, they've got apparently a big strategy session rethink coming in November, so it's good timing for Nedbank to be coming on board right now. The bulk of their revenue, about 60% of their revenue, comes from West Africa. Given the size of the economies there, do you expect that to be the approach going forward in the next 5 years or so?
Absolutely. I think, West Africa, Nigeria, Ghana will still dominate, from a geographical point of view. But they're in something like 35 countries throughout the continent. So you can only imagine the growth opportunities that presents, from those smaller geographies. You must remember that sub-Saharan Africa, excluding South Africa, is growing at 5.5%, 6% a year. And if you just put that in context of global growth, this is definitely a place you want to be in if you're a bank.
Again, and we say this often, Wayne, it's a glib statement, fantastic growth, you want to be there, it's a big emerging consumer, many risks though, many different jurisdictions, legislations, regulations.
Yeah, look, it's not, the whole Africa growth story is not dissimilar to where China was probably 20 years ago. You're starting to hear the story of growth, you're coming off a very low base, you've got terrible infrastructure. When I say infrastructure, I don't mean port, railway, electricity, I mean legal system, legislation, the rule of law. It's just a very risky place to do business. But, maybe the strategy there is to go and buy an established player who probably knows more about operating than what you know about operating there. And I mean, the rest of Africa, I mean, the growth potential is huge. It's the only sector in the world where last week, whenever it was, the IMF upped the growth forecast, didn't cut it. They actually upped it. Yeah. So, but at the moment, everything is effectively Nigeria. But that growth will eventually spread into Africa. And when you look at Africa's share of fixed investment, it's actually huge. So there's great potential. I still think, it's a 10, 15-year story. But if you want to be there, you got to start quite soon. And, maybe the way, as I said, is to go and buy established players.
Yeah. So what Wayne is suggesting this, and initially it might not be that profitable, although we know EcoBank is nicely profitable. But there could be some jerks along the way.
Absolutely, but I think Nedbank should use this as an opportunity to get some experience working in a geography outside of South Africa, like Standard Bank did all those years ago. Initially it's going to be dilutive in terms of returns on equity. Loan loss provisions are going to be high. We're going to hear some horrible stories coming out of their governance issues we've already dealt with. But I think in time, once you've got the experience, as Wayne says, this is a 10, 20-year story. And this is the right footprint for Nedbank.
Okay, so let's talk, you mentioned Standard Bank, so let's talk about the different ways in which the JSE-listed banks certainly have approached the African expansion, and they're all different, some more successful than others. Well, let me ask you first, before we go into the detail, Nesan, which do you believe is the most successful thus far, or the most promising?
I think in terms of the Africa growth story, it's basically a toss-up for me between Barclays and Standard Bank. Barclays was quite fortunate because they were able to acquire an existing branch network that was there already, through its association with the parent Barclays Group PLC. Standard Bank has probably got the longest history in Africa, and I think you'd be naive to think that they can't make that a success. FirstRand's gone a completely different approach. They've started now with a bank in Ghana, which they're going to start from a greenfields bank in Ghana. They've had difficulty making an acquisition in Africa, so they remain the only South African bank without any African exposure at the moment, and that could work in their favor. Or I think they have got a strategy of acquiring and growing in Africa, but it's more organic growth rather than acquisition at the moment. So it's still early days, but you know, it's interesting how the various banks have approached the African growth story.
So Wayne, I'd like your views on that. So
yeah, sure.
as Nesan said, Standard Bank did it the long, hard way, one of the first South African corporates to have gone that route, and also more recently, in recent years, extracting itself from most of its non-African territories, focusing on this region.
Now look, I mean, Erica, when you look at, I suppose, global trends, you know, 15 years ago, the trend was South African companies, you had to go overseas. You had to go to the developed market. And when you think of what Old Mutual, Investec, lots of other people, they lost huge amounts of money. First Rand didn't go there. So they were spared that thing. Now it's the Africa growth story. Maybe going a little bit conservatively and a little bit slow, finding your feet is not a bad strategy. It's not a bad one. I still personally prefer buying an existing player, like Barclays did from Barclays PLC.
Far less
and
risk.
Nedbank now. There is less risk,
but you could
involved.
be overpaying compared with your slower peers. Yeah.
But look, if you buy a good asset, the overpaying only hurts you the first couple of years. You know, after that, people forget about you overpaying if you're actually buying a good asset. Of course, they'll never forgive you if you overpay and you bought a bad asset. So there's still lots of time to get into it. I mean, I remember when Shoprite went into Africa, the inimitable Whitey Basson said this is for his grandchildren. And look, I mean, if they didn't have Africa now, their growth numbers would have been terrible. So you have to go out there, and we'll obviously over time see which is the best strategy. But I think if First Rand could find something to buy, they would actually buy it. They're not going this route because this is the stated goal. This is maybe the only available route because they just can't find anything to buy.
Yes, yeah. So pulling it together, Nesan, so the implications for someone looking at their share portfolio. So given the long-term strategy and the significance of Africa in that strategy, implications for earnings, what would your bank pick be?
I think, you know, at the moment, it is actually First Rand because the African growth story hasn't really filtered through yet. But I think looking forward, I mean, in the next 2 to 3 years, you're going to have to factor that into your portfolio selection. You know, First Rand is just it's our pick because it just happens to be the best run of all the banks. It's got a higher return on equity. It grows earnings at 20% a year, and you know, it's really it's the best managed bank on the JSE at the moment. But in future, I think the African story will have to be factored in.
Indeed. Wayne, your pick in the sector?
Look, I actually like Barclays simply on a share price rating view. Look, banks are cyclical. 5 years ago, no one wanted to touch First Rand. It was the worst bank. Yeah. And then before that, Absa was the worst. And then before that, Nedbank was the worst.
So
and then Standard Bank was. So they all have a turn being the best and the worst.
Yes, yeah.
So, but on a pure share valuation level, to me, Barclays Group Africa looks the cheapest. But they're all reasonable value, I must say.
Yeah. Well, thank you. Lovely talking to you about African banks. And that's it for this week's Deal Flow. Thanks to Wayne McCurrie and Nesan Nair for joining us. From me, Erica van der Merwe, and the entire Deal Flow team, it's goodbye for now.